G'day listeners and welcome to another APS News Bulletin, keeping you up to date and well informed on everything happening in the Australian property market in real time. Guys, story number one, what could another rate rise do to the Australian housing market? Article by Eliza Owens, Head of Research over at CoreLogic. Why are housing values increasing despite higher interest rates? There are a few explanations for why housing values have continued to rise even as cost of debt has risen and borrowing capacity has eroded. Part of the explanation comes from low supply relative to demand. Tight labour market conditions and an accumulation of savings through the pandemic have broadly underpinned mortgage serviceability, mitigating a need to sell as rates have increased. The construction sector remains squeezed and unable to deliver a large backlog of dwellings, and strong population growth has increased demand for housing, both for purchase and for rent. In the June quarter, there were around 127,000 homes purchased, but only about 125,000 new listings added to the market for sale. As long as there are more people willing to purchase a home than sell, prices should theoretically continue to rise. The composition of buyers may also be propping up purchases, with higher deposit sizes indicating the current buyer profile may be less dependent, or debt dependent that is, than when interest rates were at record lows. Other demand side factors influencing housing purchases could be the predominance of variable rate mortgages in Australia. Buyers may be pricing in a future reduction in the cash rate to their purchasing decisions, with the expectation that they are buying in or around the peak of the rate cycle and that their mortgage rates will trend lower over time. From this perspective, a further rate increase could certainly slow demand and signal to the market that interest rates are not yet at a peak, or at the very least are likely to take longer to reduce. She also writes, another rate rise would slow housing demand and some cracks are already showing. Buyer demand seems generally skewed towards cheaper markets, with Perth now being one of the primary markets driving growth in capital cities. In the month of June, it is estimated that Perth accounted for 32.5% of the 0.7% uplift in CoreLogic's Capital City Home Value Index, which obviously is only over a month, so it's a very small percentage. Adelaide has also contributed more to the headlines growth figure through June, up 14.2%, up from 4.1% a year ago. The RBA have expressed an extremely low tolerance for any further uplift in inflation. Right, it's really key here, guys. It's extremely low tolerance for any further uplift in inflation. So if we see that continued uplift or staying stubbornly high, any sort of movement, that's where we could be in some issues. The Reserve Bank's own deputy governor has been noting that it'd be a bad mistake to base increases based on one result or one decision, highlighting that the quarterly inflation figures, the labour market report, and retail sales data could also feed into the rate decision. So multiple things at play here as well. Other economists have pointed to the limitations of the monthly CPI measure, which does not always indicate the direction of the quarterly result. Westpac's economics team have predicted that the increase in the headline result to 4%, in part due to base effects, despite ANZ and NAB now revising the timing of the first rate cut to 2025. None of the four major banks are anticipating another rate rise just yet. However, if rates do not increase further, housing purchases are expected to slow as economic conditions become weaker and affordability constraints play out. Labour force conditions are clearly starting to unwind as job vacancies drop, employment growth slows, and the unemployment rate rises lift, which will limit new demand and possibly weaken mortgage serviceability if mortgage holders become unemployed or work less hours. Now, guys, in summary to this, whilst it is unlikely another rate rise could happen, it isn't fully out of the question. Inflation is staying stubbornly high, and this is a huge indicator the RBA and the government want to get it back under control and get it under control ASAP. Remember where it's said in there that the RBA has an extremely low tolerance for any lift in the inflationary numbers right now. It is more likely that inflation does come down over the next 6 to 12 months, and rates potentially will come down with them at the same time. But really, this is going to be closely linked with inflation, what happens on that front. And it doesn't fully rule out a rate rise if that does stay high or potentially does push up any higher. The lower end capitals, as they've kind of jumped in there as well, the lower end capitals are driving house price growth with sustained affordability, although this needs to be carefully monitored as some cities are nearing affordability caps. As Big Timmy Lawless and I went through last week, guys, that's a really important thing to keep an eye on as to where that is sitting in different cities, how that's looking from that perspective, and then keeping a really close eye both from the inflation numbers and all the other indicators we ran through last week as well. Hope that gives you a bit of an idea as to what can happen, but realistically, lower end capitals, cheaper, more affordable markets compared to incomes in the area. They're obviously still got some good fire in the belly, still pushing forward, still got propensity to continue to move forward. If a rate rise was to come in, these top end markets that are unaffordable, that have seen a lot of growth already, they could be in a bit of strife if another rate rise does come to the party. Story number two, guys, is super contributions have increased from 27,500 to 30,000 a year. Article by the ATO. The concessional contributions cap is the maximum amount of before-tax contributions you can contribute to super each year without contributions being subject to extra tax. So from the 1st of July 2017 to the 30th of June 2021, the concessional contribution cap for each year was $25,000. From 1st of July 21 to 30th of June 24, the concessional contributions cap for each year was $27,500. Now, from the 1st of July 2024, the concessional contributions cap is now $30,000. So as you see over every 3-4 years here, they're kind of bringing in, and this is very much in line with inflation and CPI and what you can actually buy with your money. They've increased it every 3 or 4 years by a $2,500 amount. It's not a huge amount, but if you've got enough surplus that you can direct more into super each year, it obviously is a little bit extra you can put in there and save a little bit more on your tax every year, adding to your super. The cap increases in increments of the $2,500 in line with statistical measure of average weekly ordinary time earnings. ATO speak there, guys. The concessional contributions cap is the maximum amount of before tax contributions you can contribute to your super each year without contributions being subject to extra tax. If you have unused concessional cap amounts from previous years, you may be eligible to carry them forward to increase your contribution caps in later years also. Another interesting piece of this as well, guys, is you are able to carry forward unused contribution cap amounts. Now, this is something that's interesting. If you've potentially, this also can weigh in, guys, if you've got a big capital gain that you're selling. Now, obviously, everything here is prefaced with you should be, speaking with your licensed financial advisor or your licensed tax agent around this as well. But quite potentially, if you have a big capital gain one year, maybe you bank $200,000, $300,000 worth of profit, what are you going to be doing with that money? And could a little bit extra potentially be kind of, in effect, like salary sacrifice or put towards this and pay a lower amount of tax rather than potentially paying at the highest tax bracket. If you bank $200,000 worth of profit, even if that was potentially what was left after your 50% capital gains tax exemption, if you were eligible for that, you might be sitting in that 45, 47 cents tax bracket. Were you able to get to the super tax bracket of 15 cents in the dollar and get down around that, for a couple of years here, even if you do a bit of an add back? So something to discuss with the accountant if it's something that's suitable for your situation and that, that surplus there isn't going to be a huge game changer for you banking personally. It might be something you might be able to put towards a self-managed super or superannuation funds in general. Just to round this out as well, guys, what we're talking about there of the unused contribution cap amounts, they're available for 5 years and they'll expire after this, and they start from that 5 financial year periods back from there. But as we're kind of saying here, and again, in summary of this, before we go any deeper with this or go any deeper, speak to your licensed financial advisor and your accountant about this. You want to be all over this thing if you're thinking about doing it from this perspective. So don't take my word for it. Obviously, have a chat with them about it. This is also for this financial year, not for last financial year, but any of those carry forwards, they would be from previous financial years as well. But if you did have any big capital gains to bank, or if you're going over that highest tax bracket, highest tax threshold as well, it's always worth having the conversation with your accountant as to, is it worthwhile, depending on what your living expenses are as well, is it worthwhile doing the salary sacrifice additional amount into super? Yeah, because now obviously you've got the extra $2,500 that you can do at the reduced taxable amount. That's it, guys, for another APS Weekly News Bulletin. I hope you took some great value out of this thing. If you did, please make sure you send it on to someone else who those two topics might be relevant to, or someone else you might think might take some great value out of this episode. Until next week, guys, that's another APS Weekly News Bulletin on the Scouting Australia podcast.